No, the difference with Annex Wealth Management, it's a loss when someone passes. But when they took the time to do things correctly with a well-constructed estate plan, it makes distribution of assets far easier. And if you're on the list for some of those assets, there are right and wrong things to do. And you also need to manage your expectations. Alec Durand is an estate planning attorney at Annex Wealth Management. Got experience in all of this. Hey, Alec.
Hey, Danny.
We're going to cover key aspects of inheriting money as well as covering the ramifications like taxes, the need to be patient, and the expectation there might be some surprises in store, right?
There can be, especially if you're unprepared.
First thing to determine is what you're inheriting. Is it cash, investments, real estate, or IRAs, 401ks? Why does that matter?
It matters because different assets are treated differently, particularly for tax purposes. For example, retirement accounts like IRAs and 401ks are subject to something called the Secure Act, and other assets, depending on certain circumstances, could be entitled to step up or step down in basis.
One thing you can be sure of, there are tax ramifications to inheriting money. This term, basic adjustment at death, what does that mean?
So a basis adjustment means that the value of an inherited asset is either going to be stepped up or stepped down in value as of the date of death of the person leaving you that asset, depending on the type of asset it is. Particularly things like cash accounts, stocks, and real estate can be adjusted based on whether the person that passed away had that asset appreciate or depreciate in value during the course of their ownership of the property.
Is that the same deal with like an IRA?
No, IRAs are typically not entitled to an adjustment in basis. And as I alluded to earlier, IRAs are subject to the Secure Act. So there's different rules regarding inheriting those assets depending on your relationship to the person that left you the asset. For example, most non-spouse beneficiaries of IRAs are going to be subject to the 10-year rule under the Secure Act, which means that they are going to have 10 years or December 31st on the 10th year after the date of death of the person passing away to completely liquidate their inherited account.
The ramifications of inheriting money. We're talking with Alec Durand, an estate planning attorney at Annex Wealth Management. Next question, when inheriting money, how are you inheriting? There's three ways. There's outright, there's jointly, and then there's in a trust. Let's talk about outright.
From a conceptual standpoint, that's probably the most simple way to inherit an asset. And it's when someone just leaves you individually as the inheriting person. So they named you on the payable on death of a bank account or something like that. And what it means is that once you obtain possession of the asset, you own it individually. You can do whatever you want with the asset. It's yours.
How about jointly?
It's somewhat similar, but it just means that you don't have sole ownership of that asset. It's most common in the real estate scenario. So grandma or grandpa passes away and leaves you joint ownership of a rental cabin or a vacation property. So you just need to be cognizant of the fact that you don't wholly own that property. And depending on how well the person laid out their estate plan, there could be certain restrictions on what you can do with your ownership share of that property.
And then there's inheriting money within a trust.
Generally, when you inherit money in a trust, it's an irrevocable trust, meaning that you can't go back and change the terms of that trust. So you need to be aware that there could be restrictions left under the terms of that trust on what you can do with that property, whether you can divest yourself of it and when and if you're going to get control of that property.
We see a lot of this at Annex Wealth Management, the ramifications of inheriting money. We can offer a couple suggestions. The one, and this is just common sense, don't spend it before you get it.
Absolutely. Estate administrations, whether there's a trust involved or whether it's a will-based estate plan or whether there's no estate plan in place, administrations take time. There's going to be wrinkles that pop up in any situation. There's also going to be debts and expenses that have to get paid as well as any applicable estate taxes. The figure that you see on a balance sheet might not always be the figure that you're going to end up inheriting. So it's important to remember to keep a clear head and make decisions only after you've actually received the inheritance, not before.
And then keep in mind, Uncle Sam's going to come knocking.
Right. If there's any applicable estate taxes, that could take a hit on it. And also, depending on the asset that you inherit, you could actually owe income taxes. The best example is, a traditional IRA or a 401k. Distributions from those assets are ordinary income. So you will have to pay income taxes based on those distributions, and you need to be aware of that when you're inheriting them.
And our final step is be prepared to deal with your inheritance as part of a trust that will be a little bit more controlled.
It can be. Typically, estate taxes are going to be treated the same way, whether you're inheriting something outright or in a trust. The difference becomes of whether the assets are going to accumulate inside the trust or whether they're going to be distributed to you outright. It can affect whether there's going to be income taxes at a trust level or at your personal level. You also need to be aware of any restrictions placed on that trust. If someone else is going to be the trustee, you have to be willing and prepared to work with that trustee in order to get access to your inheritance.
Ramifications of inheriting money. Alec Durand is an estate planning attorney at Annex Wealth Management. Thank you.
Thank you.